Hi everyone, welcome to another episode of VCTV. Today's topic is early stage venture and seed investment. I'll be happily moderating the show today. I'll quickly introduce all of you to myself. I was in Singapore and Jakarta for 15 years in investment banking. I had my own family office fund there, and this is my seventh year back in India. I did investments, then I went back to advisory. Currently, I'm connected with 300 investors globally. I've given 160 talks all over the world, which can be seen on YouTube and VCTV streaming sites. Apart from this, I am being awarded as a top 10 women leaders in wealth management 2021, and my brand Convanto comes under the top 10 women entrepreneurs brand. So, very happy to moderate today's show with our esteemed panelists Alexis and Tobias. I would request Alexis to kindly introduce yourself to the audience.
Yes, hello. I'm Alex Sheikh. I'm partner at Supercap Digital. We have $2 billion under advisement from ultra high net worth individuals and family offices. I'm also partner at DLT Capital, where we have raised 1 billion euros in 50 plus projects.
Welcome on the show. Tobias, would you like to introduce yourself to the audience?
Absolutely. It's a pleasure to be here. Vandana, thanks so much for hosting us today. Quick background. I'm an early stage investor in the emerging tech space covering blockchain, crypto, AM, ML. With Blockchain Founders Fund, we are an early stage VC, backed 60 companies over the last 2.5 years, and now in a process of raising our $75 million fund out of Singapore. We can invest in about 200 more companies over the next 4.5 years. Previous background is in investment banking, was an operator as well, and with a US fund in the early stage space as well.
I see, I see. So let's start with today's topic. Alexis, what does a VC or an investor look at before investing in an early stage startup? And what do they expect from founders?
That's a good question. The main point is always to focus on having an experienced team and to only focus on the product market fit in the beginning, because that's the only thing that counts, those two things, when you are seeking venture capital funds at the seed level. That also means that you have to have taken care of your pre-seed funding. We focus on raising capital from seed to Series A. So that means that pre-seed funding has to be closed by family, friends, and other people. You should focus on angels, and you should also have closed at around 500K in US dollars to be entering the seed stage, at least.
Yes, totally agree. What do you think, Tobias? What does a VC or an investor look at before investing in an early stage startup? And what do they expect from founders?
Yeah, fantastic question. So it really depends on what you see as early stage, right? Some of us, we look at the pre-seed deal, which is very early, where you sometimes pre-revenue, pre-product. It could go even earlier. Like if you look at Entrepreneur First or Antler, where they literally go like on an idea stage even, or early stage could be in a Series A as well. I would define it sort of pre-seed seed stage, where, in my opinion, you invest in a vision, right? You invest in a founder, because from a track record perspective, there's not much yet from a financial, traction where you can, look at numbers, KPIs in that sense. Typically they have them modeled out, and it's based on assumptions, which is a great indicator of understanding how well a founder understands the market by figuring out how well rounded these assumptions are. but of course the numbers might not be fully correct, right? Because there is no record. So for us, important is the founder's background, the vision they're building, how committed they are to the project they're building at the moment, and then we figure out a lot of questions around the product market fit, right? How have they researched the idea? Have they connected with customers? Have they kind of understand that this is a real pain point in the industry, and are they able to provide a solution which offers a either new opportunity in the market or is substantially better than competitors in one way or the other. And it also depends a little bit on how hands-on you work with the founders. For us, it's important that the founder is coachable in a sense, right? Not that we're going to tell him what to do, because we also don't know all the answers, but at least you want to work with him and figure out, okay, what can we do in order to improve, pivot, or grow the business together with the founders and with the founding team.
Yeah, totally agree with you. I mean, I also feel, how you present yourself. I mean, your pitch decks, your video pitch decks, and how you, come across to the investors in your pitch deck also matters a lot. I mean, I always feel that's a very important part of pitching to the investor. Uh, Coming to my next question, I mean, how can early stage startups raise funds through seed or VC investments? Alex, would you like to answer that question?
Yes, I can add to what you just stated. I think as we call the professional collateral material is very, very vital. You should have a one-pager in place and a good pitch deck. And in there, the most important thing is the storytelling aspect. And what I mean with this is most do not get that what's relevant for VCs and investors, qualified investors, it's only the investor's perspective. So that's what we focus on. They want their screening and their questions to be answered. What most founders do is that they focus on their perspective, the marketplace problem, etc. So have your storytelling in order and focus more on investor-related answers. That's very, very important to get the attention and the interest. And then you're in the sales process. First, you have to attract by getting the first attention, interest, and then they have to have the desire to invest, and then they also have to make the call to actually invest in your startup. So storytelling, and I will also add that a very smart way that I don't see many do is that actually buy advisory shares, bring in very, very early after the pre-seed funding active advisory board members that have done this before in the same space, that you pay through advisory shares. They add value, they get paid shares, 1-2% from the cap table. And then they can represent in their fields of expertise. They can open up to the right strategic partners, the right investors, etc. And they know also much better than the average founder on how to communicate with investors. So that's my best take on that. Bring in advisory board members, active, qualified, been there, done that themselves.
Great. Toby, what are your thoughts? Would you like to add something to what Alex said? That how can an early stage startup raise funds through a seed or a VC investment?
Yeah, I mean, Alex just mentioned very good points. I just want to touch on maybe even go a bit earlier, right? I mean, there's two things I just want to highlight. First of all, it's also a bit on the founder itself figuring out which investor is actually a fit, right? I mean, I get so many messages on LinkedIn or even over email when it's clearly that the founder probably never looked at our website and never looked at our thesis. When they pitch as a hardware company in the renewable energy space, and we're an asset-light early-stage blockchain investor, right? And that's obviously, I mean, the industry is small, and if you're investing a lot of these investors, then it also looks sometimes a bit bad on the founding team, right? So figuring out who's probably a good investor, so also not waste your time as a founder, right? Messaging all these funds cold. So kind of avoid that, and then also it really helps. And then the second thing is, and looking at your runway, obviously you want to figure out and start the process early, right? Because it typically always takes a bit of time until investors go through your data room and follow up on calls and things get scheduled. So building a relationship with investors, I think, is important as a founder, right? Even if you're not raising or going to raise in 5-6 months, you probably want to start, getting a list together of people you want to approach, send them maybe an update, a newsletter, keeping them sort of on the ball, what you're doing. That will tremendously speed up the process later on, and you don't end up risking, needing to raise a sudden bridge round or something because you run out of cash and because the fundraising process takes longer than you expect. And then a last point I want to mention, I think, is also literally for being organized, right? Like having a data room which makes sense, having a pitch deck, and like small things. Put the logo of the fund on a pitch deck you're approaching. Like just show that you're kind of a person who thinks about what he's doing, which then shows tremendously how the team would work, right? Because early stage, there's not much to show from a from a traction perspective. So you want to shine and blink with everything else you have to make to show that you're a good organized team who can build and then sort of scale down the road, right? So all these little details I think are important. And summarizing this whole thing is like building relationships, starting early, and being organized, right, throughout the whole process.
Yeah, I totally agree with you, especially on that note when founders haven't looked up the website and they are reaching out to the incorrect investors. If it's a food startup reaching out to a tech investor, a tech startup reaching out to a food investor. So I think in that case scenario, they need to have appointed the right kind of investment banker who has the right kind of relationships with these VCs and can guide them as to where to go. I think that's also important, apart from having right kind of advisors on board and the complementary team, of course, the CTO, the CFO, the CMO, that complements each other. Moving forward, what are the different types of seed funding for startups? Alexis, would you like to answer this question?
Yeah, of course, you can go via multiple options. You can do crowdfunding, you can do early stage, even pre-seed venture capital funds are out there. I would say coming from both financial services for more than 20 years and also capital markets, and now in the alternative space, that one of the best access to capitals that are fast and active actually comes from experienced operators that are so-called super angels that have done at least one exit, and they want to go into the venture capital, and also ultra high net worth individuals that are coming from a family company background, and also single family offices from the same background. There you can actually access capital with the right advisors that can open the doors in a very, very good way. Most people, they don't know that a huge part of the early stage venture capital fund money, LPs, comes from ultra high net worth individuals and single family offices. That's a very important part of the early stage VC fund allocation, LPs. You can go direct if
I
you
see.
have the advisors with the right relationships.
Right. Totally agree. Toby, would you like to add something to this? Like, what are the different types of seed fundings for startups?
Yeah, I mean, very much agree. I think that's kind of the main things which are out there. I think maybe
Yeah.
well, one thing to add is the idea of how to invest, right? And like what to do. Like obviously you can do a price round, you can invest in a safe, what kind of Y Combinator brought to the world, and everybody uses the agreement. Um, and that's also interesting to consider, right? Because if you do a price round, you bring in a lead, then that's also time, right? And you need to agree on a valuation, and that's sometimes difficult early stage, right? So
Yeah.
what you to be end up doing is investing on a safe, like a simple agreement for future equity, which kind of gives you the right. So you don't need to figure out a price now. You just set certain parameters with a discount or something, and then which probably helps to speed up the process, right? I mean, in some jurisdictions of the world, these are more welcome and some are not. That's up to the startup then, but that's probably something to think about when investing early stage, right? And you probably should also be aware of that vehicle or that structure when you're a founder, because some VCs might bring it up, and then it's good to know and kind of like at least understand the structure of it, of how this essentially works. And there are a lot of resources online which you and can read through it and see draft agreements.
I see. Uh, so, Alexis, what are the sectors that you are looking at currently? I mean, which sectors you feel would right to get investments, and if you could share some light on that as well.
Yeah, we focus on fintech, blockchain, and digital assets. That's our focus. Fintech is the hot potato, has been for quite a while, and I can't see that that will slow down or get less hot. It's more than 30% of the early stage VC allocations and unicorns are from the fintech related areas. So fintech is extremely interesting and will be for a long time.
I see. What are your thoughts, Toby? Which are the hot sectors? I mean, where are you looking to invest, and which sectors would you like to explore?
Yeah, very good question. I mean, we look at emerging tech, as I mentioned, right? It's blockchain, crypto, and sort of the AI ML space. And that's sort of how we invest as well. I mean, if you look at the blockchain space, and I think also what Alexis has mentioned, um,
Hmm.
we look at sort of three buckets which we think are interesting, right? The first bucket is essentially blockchain on crypto, what you see in the B2B space on the supply chain side of things. So we have a bunch of companies who are interesting. Um, but kind of you typically just use the core technology of blockchain without any crypto component to solve some sort of problem, right? With transparency, middleman, like all these sort of positive aspects blockchain can offer. The second thing which is interesting is we call it anything which kind of supplies the crypto industry, right? It could be a custodian, it could be an exchange, a white label credit card. We have an interesting company in the UK called Banks, supplying major companies in that space and providing these credit cards and debit cards for the crypto space. And then the third bucket, which now is growing and getting very hot, is the DeFi native bucket. That's the third one, which is DeFi and NFTs. And it kind of falls into gaming as well, where we had our first crypto unicorn, which we backed them about 200 years ago at a 4 million valuation, and now they're raising substantially higher. The biggest game in the industry, together with Axie Infinity, called Splinterlands. We had some decent success, and that's very interesting moving forward, right? And the whole tokenization of digital of real life assets, I think, is an interesting part. I want to look in more, but also on the non-blockchain side of things, right? Financial inclusion, especially since we're calling out of Singapore, where in Indonesia, Philippines especially, right, becoming an interesting market, but 73% of the people, I guess, are unbanked, right? Which the whole side of things could add tremendous value. And yeah, I mean, there's a lot of other things, but I think this is like kind of the core things we're looking at the moment.
Yeah. We at Convanto also are looking at fintech, agri-tech, food tech, health tech, AI, robotics, IoT. These are some of the sectors, ed tech, that we are looking at. So, audiences, since you know what Alex, Toby, and I are looking at, you feel free to reach out to us with these sectors and requirements. Now, moving on, how do the startup founders maintain a balance between their business and running the company while looking for funding? Alexis, what is your thoughts on this? I mean, how to maintain a balance.
Well, there's no such thing as balance as an entrepreneur. I've been there, done that multiple times. And one good way to look at it is to actually do what I told you to do here earlier. If you have active advisory board members, not sleeping partners, then they can actually represent you if they have the skills to raise capital and get you in front of the first investors, and then you get traction. You do your own live. You get more and more skills. So actually, I think it's very good to have active advisor as long as they have actual experience and ability to access a couple of good investors in the space, and also if they can bring in strategic partners, because as an ex both PE and hedge fund MP, if you use leverage is the game. If you use leverage to be able to access strategic partners that are larger than yourself, that are at the next stage in the same space, then you can actually access their platform, and that could give you a very good leverage for your own startup. So that's actually also a very good way to execute that. Both right investors and sign strategic partnerships, as long as they give you access to a larger leverage for your own business. That's the whole point.
I see. Toby, what do you feel? I mean, how do the startup founders maintain a balance between their business and running the company while looking for funding?
Yeah, I mean, a couple of thoughts been said. I think important is essentially two things. First, what I'm going to touch on what I've said previously is starting early, right, and give yourself time to raise the money, and don't just start when you're like 3 months before the end essentially, because that will, you know, that'll just give you more time to sort of figure out who's your best bet, and you can also have someone backing out, and it wouldn't kill the whole process, right? Because that also helps. Even if some people say they're going to commit, they probably might not end up committing, or something else comes up. I think another important point is really building a relationship, right? There are cool platforms like Cabal, like even a normal mail merge or a newsletter, or like just an investor database you sort of hedge and like send updates so people kind of get to know you. And then sort of touching on Alexis' point, I think it would go even further, right? If you have angel investments, of course, advisors are great, and you should figure out who are good people who actively support you. But anyone who's involved in your ecosystem, right, from an angel investor, from an advisor, from from a co-founder, anyone should be supporting this race, right, or this journey. And I think if you figure out the right people who can support you, reach out to strategic investors and figure out, starting in the first place, right, that you only bring in strategic angels if you can, or strategic advisors, and then leverage on these platforms and build that relationship. I think that's key, right? And then you can have some sort of balance of still being able to push your business and still reaching out to investors.
I see. I see. Alexis, why does a funding round fail? I mean, what are the things that makes a funding round fail? I mean, where do founders or investors go? You know, I mean, why do they
Uh,
fail?
quite, it's very simple actually. You have either targeted the wrong investors, or you have few too few investors on your list, and you are not doing this in a professional, processed way. And this I see as well all the time with DMs on my LinkedIn profile.
Mm-hmm.
If you only do 20% of the research, for example, that my analyst executes prior to any intro meeting with investors, strategic partners, corporation partners, anyone that you need to deal with in the marketplace, you will look so much more professional. I get approached multiple times, and it's less than 5% that have really done the research prior to sending the hit on the DM button, and that looks really unprofessional, because it's so easy to do some research. Everything is out there. You can Google, you can go to LinkedIn, you go through the profile, little bit screening, little bit in depth. You see what they actually do. You go to the website, you go to the team on the website, etc., etc. It's not rocket science. You have to do your homework, and it's a process. It's not a journey, which is very often stated. It's like being in a rowing boat without oars. That's a journey. For any professional, it's a process. It's not rocket science. You go to someone, or you mimic someone that has executed it professionally, and you just follow that process. That is how you do it. It's not rocket science.
I see. Toby, what are your thoughts? I mean, why does a funding round typically fail?
Yeah, I mean, all the mention, I just want to bring up one more point because I think it's important. I've actually seen this twice, and also experienced myself as an operator with a startup. So if you're, let's say you start raising, right? You have 6-7 months until, or 5 months even, until you need to close the round. A lot of people think that everything previously counts for an investor, right? But you still need to have money to keep, or execution power to keep KPIs either stable or best case improving, right? Because if you are through your due diligence process with the investors, essentially, and we constantly monitor the company, right? If you're in a due diligence process, not to look at, okay, this is the document is sent over. We obviously want to see like how you're progressing, right? How the things are going, how is your data room being updated and things like this. So imagine if you don't have any money anymore because you run out of money because you started too late, or everything just doesn't work out. And then in addition to you reaching out or like doing all the mistakes that Alexis mentioned in the first place, all your KPIs are going down, right? Because you're not able to do outreach anymore. You're too focused on the fundraising side of things. You're not able to hit your marketing milestones. And that's before fundraising. Like that's very high likely that an investor's going to pull out and say, "Oh, what's happening now? I'm not going to invest in a company which is going down," right? So it's important to keep that performance even during a fundraising process, and have someone who's like dedicated maybe to the fundraising side, or the CEO, and then people need to still run the business to an extent, right? To sort of keep that downward curve during the process, and not like scare any investor who's not building that relationship and doesn't know you for a long time.
I also feel sometimes founders put in a very, very high valuation and they box themselves in way beforehand, saying like, look, this is my valuation. So I think that also is one of the reasons why a startup fails. Quoting the wrong valuation or quoting it too high or boxing yourself, in with a valuation figure, not leaving room for negotiation. I think one of the reasons is also that, and I've seen many companies fail because of that. Also, burning the investors' money. Like we've come across 2, 3 startups wherein one used the money to buy the car, other one used to treat cancer. So I think once the founders understand that it is the hard-earned money of the investor, and it is not for burning, it is used, only for business. I think that education also needs to be imparted, and if they cannot manage their money, they need to appoint somebody like a CFO or a financial officer who can actually manage their money, and make things better for them.
Well, if they if they mismanage money, they can get sued. Even Steve Jobs, they quickly parked. They had 2 Porsches. They quickly parked the Porsches on the back of their office when they had investor meetings, just to show that they were not into buying cars, etc. So there are many ways to do that,
Yeah.
but of course you have to focus on building your business. Otherwise, you can get sued.
Yeah, totally agree. Uh, Moving on, what are the challenges that VCs and investors face? I mean, what are the challenges that they face? Alex, would you like to take that up?
Well, for them, it's all about risk management. Everything
Hmm.
is risk management, and you have first the identification of opportunities. Some call it deal flow. Most are quite unqualified. Some are qualified. Then you have an associate or an analyst doing the screening. And then you have the first meetings, you have the follow-up meetings, and then you have the actual due diligence on site following meeting, and then you have a principal and or partner that actually can pull the trigger to invest or not. So actually, it's same thing here. It's a process, and it's quite tedious, and it's quite long. So you have to have multiple engagements, and with multiple engagements, I mean, if you have a target list that we called as pros a long list, it has to be 100 qualified investors, and then you have an additional standby 50. Then you want to have at least 20 to 50 investor meetings intro, and then you want to identify the actual 10% that actually wants to do something with you, and then you want to find those 1, 2, 3 that actually will execute on your startup. So it's all about risk management.
I see. I see. What are your thoughts on the same question? What are the challenges that VCs and investors face, Toby?
Challenges we see investor face, there's a multiple different aspects, right? The first one is from a pure fund perspective, right? You have fund economics and you have LPs. They require return. So you obviously need to invest in a startup which has a very similar idea of where they want to exit or where they want to potentially land, right? If you're a $400 million fund, you wouldn't invest in a company who just wants to be the next SME and like just growing, right? You need to have probably gonna hit a unicorn to bring back your fund back, including a hurdle rate, and probably want to make some carry out of this as well. That's like the first thing. So that's also important from a founder perspective, right? Approaching a VC who has a similar mindset and is not gonna push you to exit or like just being on the same boat as well. It's not just only the investor picking the founder; it's also the other way around. I think as a second is the LP I mentioned, right? I mean, it's a very specific sort of promise you give to your limited partners and what assets and what classes you'll invest. So as much as we would sometimes love invest in this company, it just doesn't allow us because of the investment thesis we have been initially sort of agreed on. As a second thing is also of timing. I think is a challenge for every investor, right? Coming in too early, too late, especially in blockchain space, valuations go up quite rapidly. So if you're a bit too late, that could end up in a ticket size you're probably not been able to take, or you're not getting any exposure more in the round. And I think as a third is this kind of building that relationship to the founder, right? It depends a little bit if you're a pure financial investor, or if you're more hands-on than you are. It's important that the chemistry is working, right? That you're kind of building a relationship, because every investment, especially on the equity side, is almost like a marriage, right? It's like 6 to 8 years.
Yeah.
You're probably going to end up seeing some returns on the fund side. So it's really about like finding something that works, right? And then where you believe in and which kind of works. So I think these are the 4 topics I would highlight as challenges for investors.
Thanks for those wonderful insights. Alexis, what is your message to these young budding entrepreneurs of today?
Identify a player in your space that have executed successfully, and where you can do the same thing and follow that process, and adapt while you go to your own circumstances.
I see. Toby, what is your message for young budding entrepreneurs for today?
Yeah, I mean, I think they should first of all build it because they really believe in what they're doing. The most important thing is, in my opinion, solving a problem which you have validated. Because if you do that and if you execute it well, I don't think capital will be an issue, right? Investors going to come to you if you're in the right market, in the right position. And then as a third thing, I think preparation is everything, right? You want to build long-lasting relationships. You want to choose the right people, and you need to approach fundraising as a well-structured task, right? Which is potentially going to take a couple of weeks and months. I think as long as you do that, I think you probably end up doing something correct, and you're going to have some success at the end. And I think that's sort of a key, in my opinion.
Okay. Alexis, what are your closing thoughts, and where could one reach out to you? If you could tell the audience.
Yeah, closing thoughts will be that you have to understand that a cap raise takes time. If it goes very fast, it's can be 1 to 3 months. If it goes in the middle lane, it's 3 to 6 months. If it goes in the long lane, it's 6 to 9 months. And you also have to understand that when you see now, for example, this quarter, you have a peak in early stage VC funding of $160 billion. What most people here lack is the critical perspective. Most funding rounds and capital goes to very large rounds and very qualified startups. And most never raise. So that's also a part of the deal. So you have to find your way to make it work. I can be found on either LinkedIn, my profile, or also supercap.io.
I see. Toby, what are your closing thoughts, and where could one find you?
Yeah, I mean, closing thoughts, I guess, is just build a networking very early on, right? I mean, do your validation on your side by talking to angels or early stage venture capital funds in the very beginning, even though you might not be raising at the moment, but just getting feedback, building those relationships. The same thing is on a customer side to validate the product, and plan enough time, and just love what you do. I mean, I think that's just key. If someone wants to find me on LinkedIn, My email, toby@blockchainff.com. And yeah.
So, my closing thoughts are for the best investment in terms of the amount and investor relations, founders and entrepreneurs need to research the investor market and find an investor that is active for the sector it works in. And one of the most important parts of impressing the potential investor is the pitch. They need to have a well researched pitch deck. It should be precise with all necessary data that the investor would want to know. The pitch should include all projected data and justification for those projections. And I could be reached out on my LinkedIn handle or my website www.convanto.com. And it was a great pleasure to host such esteemed panelists and get wonderful insights on early stage venture and seed investments. Thank you, Alex, and thank you, Toby, for coming
Thank
and
you.
sharing your precious time
Thank you.
on this show.
Thank
Pleasure.
you.